finished the capital structure and WACC. Next, we move on to the capital asset pricing model. Capital asset pricing model, okay, the CAPM. The assumptions behind the CAPM is investors hold a diversified portfolios. Okay, so investors will only require return for the systematic risk for the portfolio. So there are some specific terms I will explain to you later. The capital asset pricing model is a single period transaction horizon. Investors can borrow and lend at risk-free rates of return. Okay, same as M&M view. Borrow and lend at risk-free rates of return. Perfect capital markets. Okay, same. No tax, no transactions. All securities are valued correctly, and that's their returns will plot on the SML. Okay, we explain it later. What is ML? Security market line. Okay, remember the assumptions first. Okay, that investors hold a diversified portfolio, systematic read only, single period model. The borrow rate and lending rate is the same at risk-free rate, and which is the perfect capital market. So we have a lot of new terms. For example, systematic risk, SML. Okay, so don't worry, we will explain to you. And the question asks you to think is whether those assumptions are realistic. Okay, you just think it, because if they are not realistic, then it's their disadvantage, right? So here, when you go to the exam hall, other than the question paper, you will have the formula sheet. So here, the formula sheet showing you the capital asset pricing model. Okay, which is you have given a formula. If you would like to find a required rate return, the return required for financial asset here, okay, is also cost of equity. Then you should have the following parameters. Okay, first of all, the risk-free rate. Okay, risk-free rate. The second is the beta. Okay, beta, and the third is the average return on capital markets. Okay, let me repeat because I remember in our another class before we share with you here. Okay, this one, what we call is market risk premium. Okay. We'll move on. Okay. The capital asset pricing model allows financial managers and others to establish what the market requires and adequate return from the investment of shareholders. And it is a method of calculating the return required for an investment based on the assessment of risk. So here are some keywords. Okay. We just mentioned here is the market risk premium. Okay, and the beta is the systematic risk of financial asset I. We have the market return. We have the risk-free rate. Okay, and it's all about the risk. Okay, we will spend some time to explain the risk here. The risk-free rate return. Okay, generally, what is risk-free rate? What is risk-free rate? Okay, there's no risk. Okay, you own an asset, and then there's no risk. The asset will generally return to you. It's no risk. What kind of asset can provide you such risk level with no risk? For example, any government issued debt, Okay, maybe you can check US or UK, okay, or those countries with the very good credit rating, the credit rating by rating agency. Okay, rating agency include S&P, include Moody's, also Fitch. Okay, they have very good rating to some government issued debts or issued debt security. So the risk level should be very low, or even you can assume they are risk-free. Okay, it's the rate, the return in those securities, in those debt securities can be used as the risk-free rate. Next is equity risk premium. It is the market rate, market portfolio rate of return minus the risk-free rate. Okay, this one is called risk premium, equity risk premium, or market risk premium. It is the difference between the market return and the risk-free rate return. So it means that any extra return required by the investor over risk-free asset. Okay, let me repeat. Equity risk premium means any extra return required by investor over risk-free assets. In general, this equity risk premium can be found in a long time horizon. Okay, not just, for example, 1 or 2 weeks, because you have a very long time horizon to observe, to study the overall market return, and then you can benchmark at the same period what's the risk-free rate. Okay, then you can get the equity risk premium. So it's not only say, for example, 1 or 2 weeks, maybe spend some years, 20 years or 10 years more. And in a lot of mature markets, like the developed countries market, the risk premium is around or ranged between 3.5% to 5%. Okay, maybe it's the developed countries. Okay, maybe in some emerging market, it can be or even higher, 7 to 10% or even higher. So it depends. If it is higher, for example, 7 to 10%, it means the equity holders require a higher rate or higher premium over the risk-free assets for any uncertainty or risk that they need to bear. And equity beta, what is beta? Beta is a measure which compares the systematic risk associated with a company's shares with the systematic risk of the capital market. It means, for example, here, if the beta is 1.2 of the company E, okay, and because remember the CAPM model is risk-free rate plus beta times the market risk or the equity risk premium. So here is the market portfolio risk premium, right? If you hold a market portfolio, what you require an extra return over the risk-free rate, what we call is market portfolio risk premium, and the beta is times this one. Okay, the beta is the relationship or the factor between the individual equity and the market portfolio. It shows the relationship between the systematic risk. Okay. So if I ask you if beta is 1, what does it mean? What does it mean if beta is 1? Okay, I will explain it later. Okay, before going into the explanation of beta is 1, okay, we have an illustration first. Here is the example or illustration about the calculating the cost of equity using capital asset pricing model. It's not very difficult, okay, because it's very straightforward. If you remember the formula, then it's straightforward. Okay, the risk-free rate of return is 4%. Equity risk premium is 5%, and then the beta value is 1.2. So the cost of equity for the company is 4% plus the beta is 1.2 times the market risk premium or equity risk premium, which is 5%. So you can find it easy. It is 10%. The cost of equity is 10%. Okay. So we just finished an illustration showing what is how to calculate the capital asset pricing model. Because in the examination, in ACCA F9 examination, don't worry about the calculation of the cost of equity if they are asking you about using the CAPM, because all information provided to you, for example, risk-free rate, beta, they will give you. And just to ensure you understand well what is the market risk premium and the market rate of return, because some students or some candidates go into the exam hall, they confuse between these two items. If the examination paper provided information is risk-free rate, beta, and the equity risk premium, and so the equity risk premium just times the beta, you get the numbers. But if it is the market rate return, the market portfolio return, then you have to use, for example, here going back, if it is not equity risk premium, okay, if it is, for example, is the market rate return, okay, then you have to remember market rate return is this one. Okay, you have taken out from the risk-free rate. Okay, remember these two different. You check the question carefully in order to make sure you don't have any careless mistake, avoiding you to pass the exam. So next is move on to the market security market line. For the security market line, okay, still remember the formula. Okay, security market line means a line showing all expected return based on different beta level. Here is return. Here is systematic risk. Or beta. Okay. Security market line. Okay, let me explain to you after drawing this chart. So what is security market line? Security market line is if your systematic risk, for example, here is beta, if here is, for example, is 0.2, here is 0.4, blah, 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 is 1, is 1.2, 1.4, okay. For security market line, it shows the relationship between the beta and the return. And if it is 0.2, okay, it means the risk is very low risk, then it's close to the risk-free rate. Okay, if the beta is 0, then it's just the risk-free rate. So here, I just asked you how about how about beta is 1, right? If beta is 1, it means what? If beta is 1, so based on the formula, right? Because risk-free rate minus risk-free rates, then is the market return. Remember here, what we call is a holding a market portfolio, the rate of return that you required. So it means if the beta is 1, is the return from market portfolio, okay? So here is the basic concept for security market line. And the other one I would like to highlight is if, for example, if your here is X and here is Y, okay, you have two shares. For example, I'll just quote using the shares or investment. One investment is X, the other investment is Y. Okay. Is it possible? Yes. For X, okay, it has beta, for example, 1.2, but the return is lower than the market portfolio. Okay. So it is a it is an overvalued investment or asset. Okay, because you have higher risk but lower return. So the price is overvalued or overpriced. For Y, it is lower risk but higher return. So it means the price is what is underpriced. Or undervalued investment. Okay. So for all area here, all area I just cross is undervalued investment. This bubble or in an area full of bubble or ring or circle is overvalued investment, overpriced investment. But assuming that if the assumptions is correct for the capital asset pricing model is correct, then it is in fact perfect capital market. There's no arbitrage. All securities are valued correctly. So finally, for X, okay, the price will adjust. The price will adjust. Maybe the price drop. Okay, maybe the price drop to a level that coming back, given the risk level, coming back to this return. Okay, because the price dropped, here is X, okay, maybe the price is dropped, so the return will be better until it is at the security market line. And for Y, given the risk, the people will go in to buy Y and bidding up the price. So the return will be coming down until it hits the security market line. Okay. So here is the explanation of security market line. And next part is about the systematic and unsystematic risk. A portfolio, okay, is well-diversified portfolio. An investor can reduce the overall level of risk. So, for example, if it's 100 stocks or 100 shares or thousands of stocks or 1,000 shares, the risk level is lower. Okay, it is not an average of each share's risk, okay, or each stock the risk. For the risk level, it will be lower even as compared to the average, okay, because you enjoy the diversification in different shares. But through the diversification, your risk can be lower, but it is a fully diversified portfolio that some risk cannot be eliminated. What we call is, okay, you can lower the risk by diversification. Those risks called unsystematic risk, okay? Risk can be eliminated through diversification is unsystematic risk. Okay. And for the risk that cannot be eliminated by portfolio diversification is called systematic risk. It's called systematic risk. Okay, just show here. And total risk is systematic risk plus unsystematic risk. Okay, here is some examples. What risk can be classified as systematic risk? For example, during the financial crisis, the financial system has some issue. The bank cannot borrow money to the companies. Okay, there's a risk here, right? Because it's the risk that affecting any companies in the market, and you cannot, for example, the investors cannot diversify the risk by investing in different companies. So diversification cannot eliminate such risk. So financial crisis or financial system risk okay, during financial crisis, is systematic risk. Okay, and how about unsystematic risk? Unsystematic risk can be eliminated by portfolio diversification. For example, just call one example like a motor company. I don't name it. A motor company has some crisis, like maybe issuing a report stating that the car is very environmental friendly car, but finally the check is not, and it is telling lies to the market. Then the people just, oh, the company is honest, and the people don't buy the car by the car produced by this company. Then the share price drop. Investor, if holding a diversified portfolio, this risk can be eliminated, right? Because for the definition of diversified portfolio here, fully diversified portfolio, it means there's no one stock has significant impact to the portfolio. Okay, because it's fully diversified. Maybe only one company share only contribute less than 0.1% of your total portfolio value. So if it is a crisis of a company hitting the share price drop maybe 50%, 60%, it has no impact to your overall portfolio because only affecting one company. It can be diversified, it can be eliminated the risk. So it's unsystematic risk. Okay, here is maybe the company specific or industry specific. Okay, because you can diversify the risk by a fully diversified portfolio. Okay.